Hello and welcome to SBI Mutual Fund presents Invest Smart Mutual Fund ke Sath, powered by ET Now. In this empowering show, we unveil the secrets to financial success. Last week, we discussed the importance of financial planning for entrepreneurs. This week, we shift our focus on women for whom financial planning is especially crucial as it empowers them to take control of their economic future. Our distinguished guests for this exclusive session are Mansi Sajeja, Fund Manager, Research Analyst at SBI Mutual Fund, and Nisreen Mamaji, CEO of MoneyWorks Financial Services. Welcome both of you and welcome to a lovely audience, and thank you so much for taking time out for this special edition on women financial empowerment. We'll be taking a lot of questions from you guys also, and since you all are investors, we would definitely love to know how are you investing and what has been your strategy, where did you learn the word of investment and in fact the concept of investment. But before that, your first investment. Can you talk about that? First time ever you've put money anywhere.
So my first investment, as I remember, was incidentally a mutual fund scheme. We had, I've been working in the MF industry for over 14 years now. And, as an investment journey, it was a physical folio opening form, which has now all changed. So you had to pay, you had to fill the 2 pages, you had to send it for physical verification, and you had to open. Incidentally, it was a hybrid fund, and I didn't know at that point of time that I would be, probably managing a part of those funds now. So, that's how it all started.
What age are we talking about?
Must be around 25, 26 years of age.
That was pretty early. Yeah, that's good.
Yeah. So, at that point of time, but yeah, that was the first financial investment. Before that, mom would have given some gold and some would have been that. But that's how all of us start. And that is how. But the remembrance I have is that form filling and opening a folio.
Exciting. Nisreen, what about you? Your first investment ever?
My dad was actually an equity investor. So I think when I got my first paycheck, I probably bought stock, which I remember, in those days. And, whatever I could afford. This first salary was 2,500 rupees.
Okay.
I was then in advertising, and I've been, in the financial services industry for the last 3 decades now. So that was my first memory. But, when my kids were born, for example, I started a recurring deposit for each of them, and then switched to mutual funds when I got into the industry on a larger footing. And that's really helped me a lot, when they wanted to educate themselves or, with all their goals. So I think that was a very interesting journey for me personally. For myself and my children.
Exciting. The sense that I'm getting from the room now is all of y'all are women investors and hardcore investor, because I saw the interest as when you said your first investment was stock, and all of them were like, wow. So let's talk about your investments. When did you guys start first, and how did you learn about this world of investment?
So like Mansi said, most of it, the first one was obviously through what the parents have given.
Yeah.
But that's not something you've handled. So for me, I think the first investment, my decision mainly was actually fairly recent when I joined Millennium Mams, where we learn about financial awareness, literacy, and the stock market. And we're looking at long-term value investing. So like Nisreen said, stocks is what we're looking at, and as holding it for as long as possible.
It is so impressive, I mean, you were throwing words like value investment strategy, and you actually joined a club where women are trained, they are taught about investments. What about you, ma'am?
So it starts with saving. So the first saving is a piggy bank saving,
I think by default we all are savers, right?
Yeah, we all are savers. And then it starts with goals, traditionally it was gold, commodities, FMCG, some topics that are women friendly, infrastructure, or, and then getting into shares, bonds, and things like that, I think.
Wow, that's so nice to know. But then one question to you now, since we over here have an audience who are aware about the financial markets, but then this scenario is not similar in all the parts of our country, okay? The narrative as far as women investing is concerned has changed a lot, especially since the pandemic. We have enough reports that say that, age-wise, women are investing in the sense 40-year-olds maybe are more in tune with their investments or with their financial planning. Recently, there was a report where, it said that savings in rural India done by women has reached a record high level. So the entire narrative of women cannot invest, okay, they are good budget controller, they are Grah Lakshmis, but being an investor, people used to see a lot of hiccups coming out there. The scene has changed. You train a lot of women. You have women investors. What are the common apprehensions that you see them facing when it comes to money-related topic, when it comes to their financial freedom?
So typically what I find is that, women tend to shy away from the investment decision themselves, even if they're women in finance and even if they are bankers, because traditionally we've been used to letting, the men in the family, whether it is your father or later on your husband or your son, manage money. And this is not only for India, okay? This is basically a feeling or the way that women are raised. That certain things, you learn and certain things you learn, even if the women are good in maths. So there has been a subtle change now, as you rightly said, that there are more women in the workforce, and when you earn your first salary, you still manage to give it to your dad to invest. But I think the understanding has come. There has been a slow change where the women, even if they make mistakes, see, because it's not going to be without a mistake-free kind of a ride. And the earlier you make the mistake and learn from it, it's better from you, because probably the amounts that you invest will be a little, less when you are in the early part of your investing journey. So that is something that now women need a little push, and also they are, as she rightly said, reading and learning about it. And it's okay to make a mistake, but the good thing is to just continue and continue investing and taking the financial reins in your own hand.
Exactly.
Whether it is through bank deposits, whether it's through policies, whatever you do, but decide yourself and then figure out the rest of the journey.
But over here, do I have an audience who handles their husband's portfolio, also the entire family's portfolio? Ma'am, lovely, wow, superb, thank you. Let's talk about that. I want to know, how do you handle your family's portfolio? Your husband listens to you, right, then? you decide for all of that.
I don't bother to tell him anything, to tell you
frankly. Lovely. There you go.
I told him, look here, I'm accountable for what I'm doing and I don't owe you any explanation.
Okay, right.
I think that women, why they prefer their husbands or fathers or sons to manage their money is because they are emotionally attached to the outcome of whatever they invest in. So once you detach, you detach yourself. Because risk management is all about, you cannot manage the risk if you're not detached. And I think that's one reason why women like gold, because they're fond of gold. They love gold. So they don't care. The gold price can escalate.
But here we can see women liking stocks also and mutual funds also. So Mansi, coming to you. Thank you so much, ma'am. I'll continue that with you. But talking about women's investment strategies, okay, do you think there is a separate set of rules and things that go around as far as women investing is concerned? Investment instruments are the same, okay? Your investor behavior might differ, as compared to a women investing or a man investing. Maybe women they have much more patience and they are literally a long-term investor. But can we decide specific investment instruments based on gender? No.
So it's not just based on gender. I'm a great follower of behavioral finance, and it, part of it is gender, part of it could be some other life stages, part of it just the way you are and what you prefer. So we have seen that women investors could be more loss averse, and we said that they may not be able to differentiate between the short-term volatility and the loss probably that an asset can give. So they may be volatility averse also. So with that regard, we always kind of educate them or tell them that, see, I mean, based on your goals, think about your goals. The goals for every person are the same. It's not gender specific. Most of us have short-term, long-term retirement goals. So think about them and look at each investment according to the goals that you want to fulfill, and try to distinguish between the short-term volatility and the capital loss that probably you think you are attaching to that volatility. So those are the subtle things that all of us try to communicate. All of us want at least investors, and this is a great platform for me to convey to them that NAVs may go up and down, but just look at it over a longer period of time and align it to your goals that you have.
And when we talk about women, I also want to cover the mindset or the investment mindset that a working woman might have, a homemaker might have, a single mom would have, or a single lady would have.
Sure. So typically, the mindset depends on the age that you are and the goals that you personally will have. So like for a single lady, I found a lot of them, want to travel. So they will have an international plan, say, foreign travel in the next 1 to 3 years. Or they might want to buy a car.
They have a bucket list.
They have a bucket list.
Okay.
So
I'm going to check out your bucket list also.
Yeah. Or, like an expensive pair of earrings. Some people like, a branded shoes, like maybe like a Jimmy Choo. I want to
Why
save up
not?
for that.
Yeah.
So it's, different. But vacation and travel, international travel is top of the, list. Also buying the first house. So you have to put down the deposit money and you're saving for that 20% that you want to put down so that you can start then paying the EMI. So these are some of the things that, the single women are definitely planning to do. Even if they get married in future, then they will club it probably with, the prospective mate. Also, young mothers, for example, if they are homemakers at that point of time, because a lot of women do take a sabbatical when the children are very young and they don't have, somebody to look after the children. At that time, they will start planning for the child. So the education goal will start immediately, and I think that's very good because then you have those 15 to 17 years to plan if you want a foreign education for your child, or say, a doctor or engineering. All those capitation fees are so high. Even the private engineering and medical colleges are so high, even within the country. So they will then start planning for the child's education through maybe an SIP per month, depending on the investable surpluses, because sometimes young families may not have that investable surplus if there's one person working, especially in the metros, because that's an expensive lifestyle if the mother has taken a sabbatical. So it doesn't matter what you start with, but what is important is to participate in the magical power of compounding. Right. So let the compounding work for you. Right. So even if they're starting with 500, 1,000, 2,000, whatever the surplus, the journey itself will be really nice because the money will work for you in that case. So then there are two individuals working and the money working with you. So that's what I try to encourage, for young women who are in the, whether they are single moms or then they are, married. If a woman in her 40s is starting, she will typically be looking at her retirement goal, because then it's like, suddenly struck you, I have 15 years left, 15 to 18 years left, and I want to, have a good retirement as well as possibly, finance the children's education. Some people also plan for kids' marriages, though these days I'm trying to discourage and saying, registered marriage is good enough. And for gold, of course, we also encourage them to buy, on paper, like an exchange-traded fund, a mutual fund on gold, or a multi-asset fund, which will also include gold besides equity and bonds. So these are some of the ways that you get the gold component in. So, you have a bit of all three in that. So I think the older women who are already retired, sometimes they come, with their entire gratuity, PPF, VRS, whatever, their entire lump sum. So if they have that amount, then we work out a retirement plan for them based on, life expectancy around 8. These days, women are really, people in general are looking after themselves, so, health conscious. So now, if you're in the metros, you look at a life expectancy of about 80 to 85. So you're still looking at about 25 to 30 years of retirement period. And we try to match the last drawn salary. Okay, so that, of course, we do the forecasting. If that works, it works, or then you take a dip in your lifestyle, which I prefer not to do. So the women start earlier, then at least, you're on budget.
Right.
And you kind of review the budget and the forecasting, your financial plan every 2 to 3 years so that you know that you're on track.
Exactly.
And if you're not, then, somewhere along the way, we change the aspirations, increase or decrease.
So anyone over here who has a bucket list or any financial goal that was lined up and you've actually achieved it?
Hi everyone.
Hi.
My name is Indu Nair and I own and manage my own brand called Indu Diva, which is into fine silver jewelry and curated handloom saris. So I'm a single mother and I will tell you what my journey of personal finance has been. So I was in the corporate space for 18 years and I used to diligently and regularly invest in SIPs, various SIPs. Equity, debt, balanced, all hybrid, all kinds, and different goals. So I was able to buy my own property, my own house, and my car.
Okay.
Yes. Thank you so
Super.
much. With the money I saved up, of course, for the house, I did put a down payment, and I took a loan from the bank, and I foreclosed that loan within 3 years.
Wow.
So I think the smart way to go about it is calculate and see. And of course, because I regularly invested in SIPs, as Ma'am
Staying
said
disciplined.
rightly, the power, the magic of the power of compounding. That has really helped me in my favor. Today, my son is studying an MBA in Canada, in Sheridan College. I'm really proud of him and of our journey
So
together.
good to know that. So good to know.
Thank you so much.
I also want you to focus on, Mansi, understanding your risk appetite. Okay, this is something that women actually don't like taking too much risk. Okay, and also when it comes to understanding investment products, when they get into it, like most of them that I've seen, and even the ladies over here, they want to understand the product in and out. But also how important it is to understand your risk profile.
Yeah. So I think women, so it comes back to getting the basics right. You have to have an emergency corpus. You have to have, as you rightly said, the family's medical insurance in place. You need to have something, a term insurance if you are the earning member, very necessary. And then understand that then when I have all that in place, then what is the risk I can take with my the portfolio. So what I need for my immediate goal, like ma'am said about travel plan or something, or what I need for medium term and what I need longer than that. We believe that women, when they don't think in these buckets, then they feel that I am very loss averse. If you have that in mind, that no, I have this in place, I can take care of myself for 6 months without even earning, I'm not dependent upon my investments for my monthly needs, then let me plan my future investments based on that. So a little bit of, as I said again, a little bit of more hand-holding is required. A little bit of, we have to tell them a little more on drawdowns.
Okay.
So they need to know that a product like this can see an intermittent drawdown, but then what happens after that? Then what happened in an event which happened, say, in 2020, or an event which happened way back in 2008, or just a particular single stock which could have reacted, something like that. But I guess, as I said, it's a journey. You have to be in it to experience it. You have to see the whirlwind yourself and to experience it yourself and distinguish, this is volatility. This could be a permanent capital loss. I need to review, but I don't need to review every day. So, all this is a journey that we are all together. As fund manager, we have learned, as I have learned it the hard way. So I can guess that. And then there are sometimes tax changes. Everything hits you the same. It's not that men are impacted differently or women are impacted differently, but everything hits you the same, and you have to be prepared for that.
Let's talk about empowering divorced women, okay? Or maybe there has been a separation because of which your finances have been impacted, or maybe you are a person who never got involved in family finances, and now all of a sudden it hits you that you really need to get your act right. How can you go about it?
So while you're still married, I'll just mention an anomaly here. That I find a lot of women, when they're dividing the expenses, the day-to-day home running expenses are managed by the woman's salary, and the husband normally looks after the longer-term plans.
This is a common phenomenon.
So this is a common phenomenon, okay? And I don't know why this happens, because...
This happens with you also?
So we've heard. I mean, this is what I'm aware of also.
Okay.
So, I mean, at every women's meet that I go to, I always tell the ladies that I speak with that it should be divided, both of them, equally. So, or also in the proportion of earning. So, if your husband is earning, say, 60% of the household income and you're earning 40%, then your expenses should be also shared in that same proportion, so that if there is a breakup, in future, at least you have your own investable surplus. Otherwise, a woman has no investable surplus of her own, and if it's a messy divorce, then she may not even get that, monthly maintenance or alimony that she would be seeking, especially if she has younger children. So, this is a conversation actually that you should be having, premarital kind of a situation. Like, you might visit a doctor to check if your health is on the same page.
True,
I remember, I think me and my husband did that. And also maybe, also visiting a financial planner or somebody who can help you start your investing journey together, because you will have a joint account, and of course there is a lot of love and hope when you start your journey, and that we shouldn't take away from that. But you have to keep in mind that you have to have your own account, and expenses should be divided like this. So if, God forbid, there is a divorce situation like this, I mean, you are already struggling with the emotional side of it, and then the financial angle will, you know, will worsen the situation. Now, if you are divorced and you're not working at that stage, then of course it's very difficult because you have to get back to work. Sometimes the alimony and maintenance takes a couple of years. If it's a court case involved, it doesn't come to you immediately. So you have to have family support for you to support yourself during those years. Or you have to have the bank balance, you know. So, I mean, there are different situations that can happen in a divorce. So, frankly, the discussion and the conversation should happen before. So that, you know, you are prepared in case there is a breakup, at least you have your own income to fall back on. Sometimes, you know, you've taken a sabbatical, okay? So then it's also important at that time to continue with your SIPs from the family investable surplus, which can be partly in your name, partly in your husband's name, and partly, you know, joint or whatever decision that you come to. If it's a joint investment, then neither of you can operate individually. But if it's an anyone or survivor kind of a option that you can take, then you can still operate that part on your own, or it could be single with one of your family members as a nominee. So, you know, the legality part of it should be kept in mind as a prenup, you know, before you get married, so that you know, I mean, it's not that you're expecting, you know, nobody expects to get divorced, and you know, you're not starting your journey with this fact, but it's just a precaution, like you take risk management, like you've taken a term insurance, you've taken your medical insurance. This is something that you should just be crossing off, ticking off on a list, and hoping that it doesn't happen to you, but if it does, you're prepared.
So having joint investment is a really perfect way to go about it? Or
so joint I don't suggest actually, because then, you know, you're stuck. And if there is a death, God forbid, then there is a whole transmission process that you have to wait before you get the money in your hands. So for that, you know, you asked earlier, basically for your shorter term goals, you shouldn't be in 100% equity. So you could select a product which has the least volatility, which could be a dynamic asset allocation fund, like a balance advantage fund or an equity savings fund, which has a minimum component of equity and more of arbitrage or bonds, so that, you know, that volatility will be sort of managed.
Right.
And for an investor who's starting out, in fact, today I met a lady with her husband who's you know, starting out on her investment journey, and she's very risk averse and he's not. So, you know, with her portfolio, I've suggested at least 30 to 50% in a dynamic asset allocation fund, like a balance advantage or an equity savings category, until she's comfortable in her journey, and then can, you know, switch to, you know, mid-cap, small-cap, multi-cap funds. So, you know, it's important to know your own self.
Also, one very important thing, money talks. So I want to know how you guys have money talks with your partners. Anyone who would want to share? Please, ma'am.
After we got married, you know, we realized that we had very strong and absolutely diametrically opposite views on money. Okay? And I am a person, you know, I would like to kind of debate about things and, you know, just try to understand and analyze before making decisions. So very early on in our marriage, when we realized that, you know, one of us is, you know, a spender, one of us is like, you know, just doesn't like to spend, and, you know, stuff like that, we came to a consensus. We had a very, you know, open conversations about, you know, okay, this is a potential pitfall. This is, you know, this is where we need to kind of manage our money our ways. So long as I think we are managing our own our way, this is an area of conflict that we absolutely avoid.
Questions? Yes, ma'am.
It's quite interesting. Earlier on in our journey, we just started out, we just earn a few thousands, right? So division of labor between husband and wife. Interestingly, we started out with I looking more at the saving options, and interestingly, my first investment was a PPF with SBI.
Okay.
Hello, I mean, it was in those days. So I was more in the savings piece, and my husband was the one who was managing the investment part. But interestingly, over time, as we evolved, you know, the roles somehow interchanged, because we realized that I'm more of a risk taker. And I'm more open to, you know, exploring things. So it's very interesting exchange. And of course, you have those little discussions and arguments. And I told you so. They can't need to telling you. But hey, that's part of life, right?
That's
so
a
it's
very
interesting.
important point. You know, you talked about, when you mentioned PPF and, you know, risk, basically that's what we do, what we call asset allocation. So it's 100 minus your age for an equity investor, which is just a thumb rule. You don't have to follow it. But, like you rightly said, PPF or say, a debt mutual fund or a fixed deposit or an NSC, all this will come in the bucket of debt. And the rest of it can be equity, whether you're buying stocks or through a mutual fund or through a PMS, etc. So it's very nice that you actually mentioned that, he did the PPF and you did the PPF and he did the equity, because you were actually doing the asset allocation for the both of you.
It's very nice that you identified as to what kind of an investor you
Exactly.
are, and just give the free way to each other. And with that, the time is up, and thank you so much, all of you, for taking time out for this very interesting discussion that we had. Thank you so much, Mansi and Isri. And time to wrap up. Thank you so much for watching. Goodbye.